The United States is facing a financial moment unlike any other in modern history. The debt crisis we are witnessing is not just a number on a spreadsheet. It represents a fundamental challenge to the trust and confidence investors have in the American economy. When nations reach this level of debt, every decision in fiscal policy matters more than ever, and every misstep can reverberate through global markets. Investors are beginning to hesitate, waiting whether lending to the world's largest economy is still as safe as it once seemed. Investment bonds that were once considered rock solid now carry a shadow of uncertainty, and that's a warning sign no economy should ignore. It's not merely a problem of numbers, it's a problem of perception, confidence, and the ripple effects on the daily lives of ordinary citizens. Adding another layer of complexity is the role of tariffs. In recent years, the administration has pursued an aggressive strategy of imposing tariffs, attempting to reshape trade relationships in a way that favors domestic producers. While the intent might be to protect American jobs and industries, the reality has been far more disruptive. Supply chains that were meticulously optimized over decades are suddenly in flux. Prices for consumer goods can rise unexpectedly, creating frustration for families and businesses alike. Global trade relationships have been strained, and uncertainty has seeped into every corner of the economy. When tariffs intersect with an already precarious debt situation, the consequences compound. The combination of rising borrowing needs and trade instability creates a storm that markets are struggling to navigate. Interest rates are another crucial piece of this puzzle. As debt grows, the cost of borrowing inevitably becomes more sensitive to investor sentiment. Should confidence waver further, the U.S. could face higher interest rates not because of economic growth, but because lenders demand more compensation for taking on risk. This scenario has a direct impact on businesses and consumers alike, as loans for expansion, mortgages, and personal credit could all become more expensive. In turn, the stock market, which thrives on stability and predictability, may see heightened volatility. Investors are already adjusting their strategies, weighting risk against opportunity, and recalibrating expectations for returns in an uncertain landscape. Finally, we must consider the long-term implications. A debt crisis of this magnitude is not something that can be resolved overnight, nor is it limited to fiscal numbers on a ledger. It challenges policymakers to think creatively and responsibly about solutions. Cutting spending, increasing revenue, or reshaping trade policies are all tools that can help stabilize the situation. But each comes with trade-offs that impact real people's lives. The stakes are enormous because the decisions made today will determine the trajectory of economic growth, investor confidence, and the country's financial stability for years to come. Addressing this crisis is not merely a technical exercise. It is a moral responsibility to ensure that future generations inherit a system capable of thriving rather than just surviving. And this is a pivotal moment, a test of policy, prudence, and vision. The world is watching how the United States navigates this unprecedented debt and trade challenge, and the path chosen now will shape the economic landscape for decades. The United States is currently navigating a financial landscape unlike anything it has encountered in modern history. At the center of this storm is the national debt, which has surged to unprecedented levels. This is not merely an abstract figure. It directly influences the confidence of investors, the stability of financial markets, and the country's ability to fund essential services. When investors hesitate to purchase government bonds, the ripple effects can be felt across the economy. Every bond sold represents a promise that the government can meet its obligations. When doubt emerges about the government's ability or willingness to honor that promise, it creates uncertainty in markets, raising borrowing costs and increasing risk perceptions. What makes the current situation particularly alarming is the speed and scale of debt accumulation. Unlike previous periods of fiscal strain, the current trajectory suggests that debt is outpacing economic growth, creating a scenario where the country must devote a larger share of its resources simply to service existing obligations rather than invest in future growth. This imbalance threatens both short-term stability and long-term economic potential, creating a cycle where confidence diminishes and costs rise simultaneously. Investor hesitation is not a trivial concern. It represents a shift in perception. International and domestic lenders assess the risk of holding U.S. debt based on both historical trust and current policy actions. When those factors are perceived as unstable or inconsistent, demand for debt instruments can waver. Lower demand forces the government to offer higher yields to attract buyers, effectively increasing the cost of financing the debt. This, in turn, can limit fiscal flexibility, constraining the government's ability to respond to crises or invest in growth initiatives. At the individual level, this affects interest rates on mortgages, student loans, and business financing. Higher rates trickle down to everyday consumers and businesses, potentially slowing investment, reducing consumption, and weakening economic momentum. Beyond the immediate financial implications, investor hesitancy signals broader concerns about the sustainability of fiscal policy. When the debt burden becomes too large relative to the country's economic output, meant the risk of default, or at least the perception of default, rises. This perception alone can shake confidence even if the U.S. technically remains capable of meeting its obligations. Market participants, policymakers, investment, and citizens alike must recognize that the challenges are not purely technical. They are deeply intertwined with trust, credibility, and strategic decision-making. Maintaining confidence requires more than balancing books. It demands a coherent approach to spending, revenue generation, and economic stewardship that reassures investors of the government's long-term commitment to fiscal responsibility. Investment. The United States faces a pivotal moment where decisions made today will have lasting repercussions on the economy, investor sentiment, and the global perception of financial stability. Managing the national debt effectively is no longer a matter of convenience but an urgent necessity, and the outcomes of these efforts will define the country's financial credibility for decades. Trade policies, particularly tariffs, have become a central factor in the United States' economic challenges, and their effects on the debt crisis cannot be overstated. Tariffs, by design, are intended to protect domestic industries by making imported goods more expensive, theoretically encouraging consumers and businesses to buy locally produced products. However, the reality is far more complex. In practice, aggressive tariff implementation has disrupted global supply chains that were carefully optimized over decades. Manufacturers relying on imported components now face higher costs and delays, which can reduce efficiency and increase prices for end products. These disruptions do not occur in isolation. They ripple across the economy, affecting both producers and consumers. Companies may absorb some of the increased costs, but often the burden is passed on to consumers in the form of higher prices for everyday goods from electronics to clothing. This, in turn, affects purchasing power and can slow overall economic growth, creating additional pressure on a government already grappling with mounting debt obligations. Internationally, tariffs have strained relationships with key trading partners. Nations affected by these policies may respond with retaliatory measures, imposing their own tariffs on American exports. This escalation can reduce demand for U.S. goods abroad, further impacting domestic industries and potentially leading to job losses in sectors reliant on exports. Investors observing these tensions and factor in the added economic risk, which can translate into increased borrowing costs for the government as confidence wanes. Beyond the immediate economic consequences, tariffs introduce a layer of uncertainty that markets do not handle well. Businesses, unsure of future trade policies, may delay investment, expansion, or hiring, opting instead for caution in a volatile environment. This hesitation can slow innovation and limit economic opportunities, while the government faces higher costs in servicing debt due to slower economic growth and reduced tax revenues. Furthermore, tariffs can distort market dynamics by artificially inflating prices and altering competitive balance, investment, creating winners and losers in ways that do not necessarily align with broader economic efficiency. Small and medium-sized businesses often bear the brunt of these disruptions, lacking the flexibility of larger corporations to absorb higher costs or adjust supply chains quickly. The cumulative effect is a strain on the domestic economy that amplifies the challenges posed by the growing debt. As the United States navigates this precarious situation, policymakers must recognize that while tariffs may offer short-term protection to certain sectors, they carry significant long-term consequences. The interplay between trade disruptions, investor confidence, and fiscal pressure highlights how interconnected global commerce and national debt have become, emphasizing that the effects of policy decisions extend far beyond their immediate intent and into the broader stability of the economy. Rising debt levels and economic uncertainty have a direct impact on interest rates, borrowing costs, and overall market stability. When the government carries a significant debt burden, lenders naturally demand higher compensation for the increased risk of lending, which drives interest rates upward. This dynamic affects not only government financing, but also every aspect of the economy that relies on credit. For businesses, higher borrowing costs can delay expansion projects, reduce hiring, or limit investment in new technologies, ultimately slowing economic growth. For consumers, elevated interest rates translate to more expensive mortgages, car loans, and personal credit, reducing disposable income and spending power. The interconnectedness of these factors creates a feedback loop where slower growth and increased costs exacerbate the underlying financial pressures. Financial markets, highly sensitive to risk perception, respond to these conditions with heightened volatility. Stock valuations may fluctuate rapidly as investors reassess the stability of the economy and the reliability of government debt instruments. Uncertainty around interest rates and borrowing costs can also affect asset allocation, leading institutional and retail investors to shift funds away from riskier investments towards safer alternatives, further influencing market performance. Beyond immediate market reactions, the potential for rising interest rates can alter expectations for future economic growth. When borrowing becomes more expensive, businesses and consumers may adopt a more conservative approach, delaying purchases and investments that would otherwise stimulate the economy. Slower growth, in turn, reduces tax revenues, placing additional pressure on the government's fiscal position and complicating efforts to manage the debt burden. Central banks face a delicate balancing act in this environment, needing to stabilize markets while supporting economic growth. Any adjustments to monetary policy, such as raising or lowering rates, must account for the ripple effects on borrowing costs, market confidence, and overall economic stability. Furthermore, these conditions can influence international capital flows. Foreign investors may reevaluate the attractiveness of holding U.S. mint debt if yields become less competitive or perceived risk increases. A decline in foreign investment could force the government to offer even higher interest rates to attract buyers, but further intensifying the cycle of rising costs and market uncertainty. For individual investors, this scenario underscores the importance of diversification, risk management, and awareness of macroeconomic trends. A volatile environment can present opportunities, but also carries the potential for significant losses if shifts in interest rates and borrowing conditions are not carefully monitored. Ultimately, the combination of high debt, potential interest rate increases, and market volatility illustrates how closely fiscal policy, investor sentiment, and everyday economic activity are intertwined, highlighting the challenges of maintaining stability in a complex financial ecosystem where decisions in one area reverberate across the entire economy. Looking beyond the immediate challenges of rising debt, trade tensions, and market volatility, it is essential to consider the long-term economic implications and the strategies necessary to restore stability. The current debt crisis, exacerbated by policy decisions and uncertainty in global trade, poses fundamental questions about the sustainability of fiscal practices and the resilience of the U.S. economy. If left unaddressed, the combination of high debt levels and protectionist policies could slow economic growth for years, limiting opportunities for investment, job creation, and innovation. Long-term economic planning requires a clear-eyed assessment of both risks and solutions. Fiscal responsibility is paramount, and this means finding a balance between spending and revenue generation that can reduce reliance on borrowing while still supporting critical public services and infrastructure. Reducing deficits without stifling economic activity requires careful prioritization, targeting programs that yield high returns for the economy while streamlining less effective expenditures. At the same time, strategic adjustments to trade policy can help mitigate the negative consequences of tariffs and improve relationships with international partners. A stable trade environment encourages investment, ensures smoother supply chains, and restores confidence among both domestic and foreign investors. Policymakers must also consider structural reforms that strengthen the economy's ability to grow sustainably. This includes fostering innovation, investing in education and workforce development, and encouraging private sector expansion in industries that can generate significant economic value over time. By addressing long-term challenges proactively, the government can create conditions that reduce the perceived risk associated with U.S. debt and borrowing. Investor confidence, once eroded, can be gradually rebuilt through transparency, consistent policy, and evidence of a commitment to sustainable economic management. In parallel, the private sector plays a critical role in shaping the future trajectory of the economy. Businesses that adapt to changing conditions, invest in efficiency, and maintain global competitiveness contribute to overall growth and help stabilize markets. Consumers, too, are integral to long-term stability. Their spending, saving, and investment decisions influence demand, capital formation, and economic momentum. Another key aspect is communication and public perception. A credible messaging about policy intentions and economic priorities helps reinforce confidence and reduces the risk of panic or reactionary behavior in financial markets. History shows that countries that navigate debt challenges successfully do so through a combination of fiscal prudence, strategic planning, and fostering trust among investors, businesses, and citizens. The stakes in the current U.S. investment debt crisis are particularly high as the country's decisions ripple across global markets and influence international perceptions of economic stability. Addressing these long-term challenges requires courage, discipline, and foresight investment, as well as a willingness to make difficult choices that prioritize sustainable growth over short-term gains. By implementing thoughtful strategies that balance fiscal responsibility, trade policy, and market confidence, the United States can position itself to emerge from this crisis with a stronger, more resilient economy capable of supporting prosperity, investment, and growth for generations to come.